Every financial influencer, every retirement calculator, every well-meaning family member is telling you the same thing. Invest everything. Stay fully invested. Never let money sit idle. The second cash touches your account, it should be moving somewhere. Index funds, ETFs, real estate, anything that earns a return. Holding cash is treated like a character flaw, like you're too scared, too uninformed, or too passive to put your money to work. And here's the thing, they're not entirely wrong. Inflation is real. Opportunity cost is real. $1 sitting in a checking account earning nothing is technically losing ground every single year. The math on that is not complicated. But the math they're not showing you, that's a different conversation entirely. Because the people who actually build lasting financial power, not impressive spreadsheets, not high net worth on paper, but real, tangible, I can do whatever I want power, they almost universally keep more cash than any financial advisor would recommend. And they do it on purpose, not out of fear, not because they don't understand compounding, because they understand something the standard advice completely ignores. Liquid cash reserves don't just protect you, they change how you operate. They change what you can do, what you can walk away from, and how clearly you think when everyone else is panicking. That's what this video is about, not the standard emergency fund speech, not save 3 months of expenses, something deeper than that. The actual mechanics of why having cash is one of the most powerful financial positions you can be in, and why most people are significantly underestimating it. I'm Matt. I make videos about the psychology and mechanics of building real wealth, not just theoretical net worth, but financial positions that actually change your life. If that sounds like what you're here for, subscribe.
Before anything else, I want to clear up a definition problem, because it's the first place this conversation goes sideways. When most people hear keep cash, they picture money sitting in a checking account earning 0.01% while inflation quietly eats it alive. And if that's what we were talking about, the critics would be right. That version of cash is genuinely expensive to hold. But that's not what liquid cash reserves actually means. Cash, in the context of financial power, means anything you can access within 24 to 72 hours without selling a position at whatever price the market is offering that day. A high-yield savings account paying 4 to 5%, that's cash. A money market fund, that's cash. Short-duration treasury bills, cash. These instruments are not investments in the traditional sense, but they're also not sitting there bleeding purchasing power every month. A $50,000 position in a high-yield savings account at 4.5% is generating roughly $2,250 per year while staying fully accessible. That's not dead money. That's your financial infrastructure earning its keep while staying ready to move. This distinction matters enormously because the entire "you're losing to inflation" argument assumes you're holding cash in the most inefficient way possible. Most people keeping intentional liquid reserves are not doing that. Do you actually know what your cash is earning right now? Look that number up. It might surprise you in either direction. Now, here's the part nobody talks about, and it's the real reason cash reserves matter. Cash changes your posture. This sounds abstract until you've felt the difference. Think about the last time you were in a situation where you genuinely needed something, a job, a client, a deal. You needed it because your finances required it. You had payments coming, you had obligations. There was a version of you in that negotiation that was subtly, maybe even invisibly negotiating from need. Now imagine that same situation where you have 18 months of expenses sitting in a high-yield savings account and you genuinely do not need this particular outcome. You're there because it's a good opportunity, not because the alternative is financial stress. Those are two completely different people walking into that room. The version with liquid reserves asks different questions, pauses longer before responding, is willing to walk away from terms that don't work. And counterintuitively, that posture often produces better outcomes. Not always, but consistently enough that the pattern is unmistakable. Desperation is expensive, and the subtle desperation that comes from being cash poor, even when you're investment rich, is one of the most underpriced costs in personal finance. Nobody puts it on a spreadsheet, but it's there. Let's talk about what's probably the most underrated benefit of liquid cash reserves, which is the actual practical ability to walk away from things. Think about what 2 years of living expenses held in accessible cash actually does to your daily life. That boss who's been making your Mondays miserable for 3 years, suddenly the calculation changes. That client relationship that costs you more in stress than it pays in revenue, you can have a different conversation about it. That business arrangement where the terms have quietly shifted against you over time, you have leverage now that you didn't have before. Most people don't stay in bad situations because they want to. They stay because they can't afford the gap. They need the next paycheck before they can think about what comes after. They're financially attached to circumstances they'd otherwise leave, and that attachment has a real cost in years, in decisions, in the compounding effect of staying somewhere that isn't right for you. Someone once described it to me as golden handcuffs. You're making good money, you have the lifestyle to show for it, and you are completely, totally trapped by both of those things because your expensive life requires your expensive income, and there is zero runway between where you are and where you'd be if you stopped. The income looks great on paper. The freedom is zero. This is one of the most quietly common financial situations in the country. People earning six figures who are one missed paycheck away from real stress. High earners who've never actually built any room to maneuver because every dollar that came in found somewhere to go. They have a solid investment portfolio, they have home equity, they have retirement accounts that look respectable on a statement. What they do not have is cash they can access without a transaction, a penalty, or selling something at whatever price the market is currently offering. And that gap between looking financially successful and actually having options is enormous. The counterintuitive part is what liquid reserves do to your external relationships, not just your internal stress level. When you're not desperate for a particular outcome, people can read it. Employers feel the difference between someone who chose to be there and someone who needs to be there. Clients sense whether you're negotiating from a position of options or a position of need. Business partners can tell when the other person can walk away and when they can't. The dynamics shift, and they shift in your favor, not because you've become more impressive, but because you've become less predictable, less easy to pressure, less likely to accept terms that aren't right because the alternative is worse. That's a form of financial power that doesn't appear anywhere on a net worth statement, but it's real, and it compounds over time, and it starts with liquidity. Cash reserves break that mechanism. Now, I want to address something directly because it's the most common pushback to this entire conversation. It goes like this. I don't need cash. I'm in index funds. I can sell and have the money in my account within 24 to 48 hours. What's the difference? Here's the difference. Selling an investment and accessing liquid cash are not the same transaction. They look similar in calm conditions. In the exact moments when you need money most, they are completely different. When you sell an investment, you sell at whatever price it's trading at that day. If you need $30,000 because something went wrong and the market happens to be down 30%, you're selling 30% more of your portfolio than you planned. That $30,000 withdrawal just cost you $42,000 in future value because you sold shares that would have recovered. When markets move fast, and in real crises, they move very fast, the bid-ask spread widens, liquidity thins, and sell at market is not the orderly transaction your brokerage app suggests. During a 3-week stretch in early 2020, the market swung 5 to 7% daily. Selling at market in those conditions means you're accepting whatever the market gives you in that moment. That's a very different thing from transferring money from your high-yield savings account. The 24-hour access is real. The price you access it at is the variable nobody accounts for until it's too late. Write this down. The cost of not having cash is never obvious until the moment you need it, and at that moment, it's always more expensive than you thought. There's a concept that the wealthiest individual investors understand intuitively and talk about surprisingly openly. It's this: the best investment opportunities in any given decade happen during periods when most people are in survival mode. Market crashes, recessions, sector collapses, these aren't just bad events to endure. For anyone with liquid capital, they're repricing events. Assets that were trading at full value a month ago are suddenly available at 40, 50, sometimes 60 cents on the dollar. Not because the underlying value disappeared, because the sellers are desperate and the buyers with cash are the only game in town. The catch is structural. For this dynamic to work in your favor, you need to already have cash when the opportunity appears. You can't sell investments to buy discounted investments during a crash without taking the crash loss on the sell side. You can't liquidate real estate in 2 weeks when a distressed property comes available. The capital has to be sitting there, ready, before the opportunity exists. Here's what that actually looks like in numbers. Let's say you've been keeping $150,000 in liquid cash reserves, a combination of high-yield savings and short-term treasuries, for several years. During that time, you've earned roughly 4% annually on that position, so around $6,000 per year, which meaningfully offsets the inflation argument. Your friends have been telling you you're too conservative. Fair enough. Then a significant market correction arrives. Broad indexes are down 35%. You don't sell anything you already own. You keep those positions and let them recover on their own timeline. But you deploy $120,000 of your cash reserve into the market and into a commercial property from a seller who needs to close quickly. 5 years later, that $120,000 deployment, bought at a 35 to 40% discount to prior fair value, is now worth approximately $420,000. The remaining $30,000 in your cash reserve has been replenishing through your normal income. You're not starting from zero on your liquidity. You're rebuilding it. The person who was fully invested the entire time, their original portfolio recovered. They're roughly where they would have been following a normal market trajectory. They didn't lose, but they also couldn't move. The crash was just something to survive, not something to use. Same economic event, completely different outcomes, determined entirely by whether you had cash positioned before it happened. This is what Warren Buffett has been doing at scale for decades. Berkshire Hathaway regularly holds more than $100 billion in cash equivalents. The standard criticism is always the same. That's a massive drag on returns. What his track record shows is that the deployment of that cash during dislocations more than compensates for the carrying cost. He's not confused about opportunity cost. He's running a different calculation than most people. The question isn't, what am I earning on this cash today? It's, what will I be able to do with this cash when everyone else can't do anything? Let me address the inflation objection directly, because it's the one that sounds most rigorous and it deserves a real answer rather than hand-waving. The argument is, cash loses purchasing power to inflation. If inflation runs at 3% and your cash earns nothing, you lose $3,000 per year on every $100,000. Over a decade, that's a meaningful sum. The math is accurate. The framing is selective. Here's what the full picture looks like. First, the earns nothing assumption is outdated. High-yield savings accounts and money market funds have been paying 4 to 5% for an extended period. That doesn't eliminate inflation drag, but it narrows it dramatically. On $100,000, the difference between 0% and 4.5% is $4,500 per year. That's not nothing. Run that over a decade with compounding, and the gap between cash earns nothing and cash earns 4.5% is enormous. So the first step is making sure your liquid reserves are actually in instruments that earn something. If they're not, that's a fixable problem, not an inherent feature of holding cash. Second, and this is the one nobody models, being fully invested has its own costs that don't show up in the return figures. There's forced selling. If you have no liquid reserves and an emergency requires $25,000, you sell investments at whatever price exists that day. If your portfolio is down 25% when that emergency arrives, and emergencies and market downturns have a frustrating tendency to arrive together, you've permanently lost the recovery value on those shares. That $25,000 withdrawal cost you substantially more than $25,000 in long-run terms. Model that honestly, and the inflation argument against cash looks much weaker. There's decision quality. Investors who are cash poor make measurably worse decisions during volatility. They can sell. They chase recovery plays. They make changes based on anxiety rather than analysis. This is well documented, and the cost is real. Investors with adequate liquid reserves can watch a 30% portfolio decline with relative calm because they know their actual financial life, their ability to pay rent, handle emergencies, cover their obligations, is not dependent on that portfolio's current value. That calm is not just psychological comfort, it directly affects the quality of every financial decision they make for as long as the volatility lasts. There's also a subtler cost that almost never gets calculated. When you're cash poor and investment rich, every major market movement feels like a personal crisis requiring a response. You check your balance more. You read more alarming headlines. You have more conversations about whether to make a change. Each of those moments is a small tax on your attention and a small increase in the probability you do something you'll regret. The
The research on investor behavior is fairly consistent here. The investors who underperform their own funds the most are the ones who make the most adjustments during volatility, and volatility hits cash-poor investors harder psychologically, even when their investment positions are identical to someone with adequate reserves. The difference is not the portfolio, it's whether your financial survival is riding on the portfolio's short-term performance. Adequate liquid reserves take that question off the table entirely. You know your daily life is funded. The investment portfolio can do what it needs to do over time without your anxiety getting involved. Now, the practical question, how much cash should you actually hold? The answer depends on your life stage, and this is where the standard advice fails almost everyone because it gives a single number regardless of circumstances. If you're early in your career with a stable income, low obligations, and decades of runway ahead, a smaller cash reserve, 6 months of expenses plus a modest opportunity fund is probably appropriate. You have time to recover from being wrong, and the growth potential of your investments is genuinely high. If you're mid-career, managing significant fixed costs with dependents and a lifestyle that requires your income to maintain, 2 years of expenses in liquid reserves is not conservative, it's rational. That's the number that gives you actual walkaway power, actual negotiating leverage, actual freedom to make the job change or business decision you've been putting off. If you're within 10 years of retirement, the calculus shifts again. The sequence of returns risk, the danger of a major market decline right at the point you start drawing down, is the single largest financial risk you face. Holding 3 to 4 years of expenses in cash equivalents at that stage isn't fear, it's the correct structural decision. A cash buffer means you never have to sell equities at a loss to fund your living expenses because the market chose an inconvenient moment to correct. The right number is not universal, but it's almost always higher than your financial advisor is comfortable recommending, because their incentive is to have your money invested with them, not sitting in a high-yield savings account you opened yourself.
Here's the shift that actually matters, and it's not really about money. The financial advice ecosystem is built around maximizing a number. Higher returns, lower fees, maximum compounding. Get the spreadsheet as large as possible by the time you stop working. That's the optimization target, and everything else gets subordinated to it, including your ability to change your mind, your capacity to act when opportunities appear, your psychological state during the years you're supposed to be building. Liquid cash reserves are the one financial instrument that doesn't optimize the spreadsheet. They optimize the life. They give you the ability to say no, to wait, to move when the moment is right rather than when your circumstances allow. They change the decisions you make about your career, your business relationships, your investments, not because they earn a spectacular return, but because they remove the pressure that makes those decisions worse. The people I've watched make genuinely good financial decisions over time, not lucky ones, not one spectacular bet that worked out, but consistently good decisions across a decade, almost all have this in common. They're never desperate. Not because they're wealthy in some abstract sense, but because their liquidity gives them options at any given moment. And options, it turns out, are worth more than any asset class. Is this strategy right for everyone? No. If you're carrying high-interest debt, that comes first. If you're in an early accumulation phase with a very long horizon and stable income, a different balance makes sense. The math of your specific situation matters. But if you've been following the standard advice, stay fully invested, maximize returns, keep only 3 months in savings, and something about your financial life still feels tighter than the numbers suggest it should, this might be exactly what's missing. Not more investments, not a better allocation, a bigger cash position in something that actually earns that you're not touching until you need to, either for an emergency or for an opportunity. Because here's the thing about financial power. It doesn't come from having the best performing portfolio. It comes from having options when other people don't. And options require cash. What would you actually do differently if you had 2 years of expenses in liquid reserves right now? Sit with that question. Because most people, when they actually answer it honestly, realize the list is longer than they expected. The job conversation they've been avoiding. The client they'd let go. The business idea they keep shelving because the timing never feels right. The investment they watched pass by because the capital wasn't there. None of those things required a better portfolio. They required liquidity. That's the thing about cash that doesn't fit neatly into a return calculation. It doesn't just sit there. It quietly expands what's possible. It changes which rooms you walk into and how you stand when you get there. And it makes every other financial decision you make, every investment, every career move,